In the darkest days of the 2008 financial crisis, governments around the world faced a decision no one wanted to make. Do you rescue collapsing banks with public money, or do you let them fail and risk destroying the global economy? There was no manual for this moment, no precedent at this scale. Only fear, pressure, and ticking clocks. This is the story of Too Big to Fail. Not as a slogan, but as a reality that reshaped modern finance. By September 2008, panic was everywhere. Lehman Brothers had collapsed. Credit markets were frozen. Banks no longer trusted one another. Even institutions that appeared healthy were only days, sometimes hours, away from failure. Money itself was becoming suspect. At the heart of the problem was interconnection. Banks weren't isolated businesses. They were deeply woven into the fabric of global finance. Through derivatives, loans, and guarantees, one bank's failure could trigger losses across dozens of others, and once confidence vanished, the system seized up. Governments realized something terrifying. Some banks were no longer just too big to fail. They were too connected to fail. If they collapsed, the shockwaves would spread far beyond Wall Street into jobs, pensions, savings, and entire national economies. This was the moment when the phrase "too big to fail" entered the public consciousness. But behind the scenes, the debate was fierce. Should reckless institutions be rewarded with bailouts? Should taxpayers bear the cost of private risk-taking? Or was saving the system more important than punishing failure? The first major rescue had already happened. In March 2008, Bear Stearns collapsed and was absorbed by JP Morgan Chase with government support. That rescue sent a signal, intentional or not. Some banks would be saved, but which ones? Then came Lehman Brothers. When Lehman failed, markets expected a bailout. It never came. The decision shocked the world, and almost immediately, officials realized they may have underestimated the consequences. After Lehman, panic turned into free fall. Money market funds broke the dollar. Commercial paper markets froze. Companies couldn't borrow to pay employees. The global economy was choking. Within days, governments reversed course. If Lehman was the line in the sand, everything after it would be saved. The most dramatic rescue was AIG, an insurance giant with tentacles across the global financial system. AIG had written massive amounts of credit default swaps, insurance on mortgage securities. When those securities collapsed, AIG couldn't pay. If AIG failed, losses would cascade through banks worldwide. So the US government stepped in. More than $180 billion was committed, not to save AIG itself, but to protect everyone connected to it. Soon, bailouts became unavoidable. Banks received capital injections. Guarantees were issued. Central banks flooded markets with liquidity. The Troubled Asset Relief Program, or TARP, authorized hundreds of billions of dollars to stabilize the system. Unprecedented, controversial, necessary, according to policymakers. But to the public, it looked different. Ordinary people were losing homes, losing jobs, losing savings. And yet, the institutions that helped cause the crisis were being rescued. Executives kept bonuses. Banks survived. Losses were socialized. Trust eroded even further. This created a moral dilemma that still exists today. If banks know they'll be rescued, do they take even bigger risks? This is known as moral hazard, and it's the dark side of too big to fail. Governments tried to address this afterward. New regulations were introduced. Capital requirements increased. Stress tests became routine. The goal was simple: make banks safer without breaking the system. But critics argue the core problem remains. Banks today are larger than ever. Financial products are more complex. And the global system is even more interconnected. Too big to fail never disappeared. It simply became too important to touch. And this raises an uncomfortable question. If the next crisis comes, and history suggests it will governments have a choice? Or will they once again be forced to rescue institutions they cannot allow to fail? The truth is, modern finance runs on confidence. And confidence is fragile. When it breaks, governments become lenders of last resort, and sometimes owners of last resort. The lesson of 2008 isn't that bailouts are good or bad. It's that systems built without failure mechanisms eventually face impossible choices. And in those moments, perfection is not an option, only survival. Welcome to Cash Chronicles, where money, power, and history collide.